Hi, this is Jonathan Miller, and welcome to the What It Means podcast. I, for those of you who don't know me, I am the co-founder and CEO of Miller Samuel Real Estate Appraisers based in New York City. Been doing that for nearly 40 years. I am the author of the Douglas Elliman Market Report series, which I've been doing for about 31 years. I teach market analysis at Columbia University, and I've been doing that for about 7 years. And I'm the author of Housing Notes, which you can find at housingnotes.com. And I've been writing them for about 11 years. So a lot of, I'm sort of showcasing my age. What I want to address a few things this week. The title of this podcast is called Finding Certainty. And actually, I spoke at a Rebney Residential Market Pulse event, which I seem to do about every quarter. And we did talk about the idea of sort of a way to think about the uncertainty that everybody in the real estate space is facing at the moment. And I'll get to that in a minute. First, I wanted to talk about a couple of things. One is sort of just a thing that I've been writing about for in my housing notes for I've written about it many times, is that building in San Francisco that was sinking and tilting. It was a luxury. It's called the Millennium Tower. And I bring this up because uh, sales in that building, at least turnover in that building, is is starting to normalize. And so, who would have thought that a building that was tilting 6 inches, 16 inches rather, 16 inches, and I'm sorry, sinking 16 inches and tilting about 2 feet, uh, could be fixed with 400 or 500 apartments in it. It's quite a monster. And it was. And over the last year or so, it's been confirmed that the building isn't sinking anymore. And I actually wrote about this in Housing Notes last week, called That Sinking and Leaning Feeling in San Francisco is Fading. And I bring this up because, first of all, it was fascinating to follow this, uh, as it evolved beginning about 9 years ago. But also the idea that some things aren't forever. And one of the things about this building was, people, that became their pied a terre or their retirement home in the city. And then all of a sudden, they're in a building that needed $100 million fix to keep the building from sinking. I don't know, call me crazy, but the idea of building a tall tower on a earthquake fault line in sand, I don't know, call me crazy, but that doesn't seem to be a good idea. But they did install a lot of pilings. I forget how many, but it was quite a few. And they were able to sort of tilt it back and have it stabilize. So then the next question is, how long does the stigma of this last? And, what is the state of the market in the building? And the first thing, that everybody's talking about, well, our price is back, because generally, the Wall Street Journal did a great piece on this, which I link out to. I think I did it as a gift link, so if you don't subscribe to the Journal, you can check it out. But it's sort of an exercise in, they went back over time and looked at, uh, repeat sales, like have sales come back. In the general sense, is that prices are about 20% less than what people paid. However, I don't specifically cover San Francisco, but the market is down or off from where it was a few years ago. So I'm not clear how much of that is market related or building related. I think the point the bigger point for me, and it's always the point when I think about the health of a housing market, is less about the price direction in the short term and more about transaction volume. In other words, if sales levels normalize, then you could argue that the building is back and sort of subject to market conditions. One of the things I've found in the markets that I cover, I don't cover San Francisco, but one way to look at whether a building activity is normal is, it's sort of the way to look at it is like, that I've mentioned before in other podcasts about sort of turnover, months of supply. But even in a different, another sort of way to look at that is um, turnover. So in a typical multifamily, condo type building, condo or co-op, but in this building is a condo, we tend to see, in my experience in the markets that I cover, a turnover rate that's normalized of about 5 to 10%. Meaning that if you have a 100-unit building, you expect 5 to 10 units to sell every year. If you have less than that, that could mean a problem. It doesn't necessarily mean a problem. If you have a lot more, that probably means there's some kind of issue where people are sort of fleeing the sinking ship. And the turnover in this building last year was about 5%, as far as I can tell, which is fairly normal. So I think the takeaway from this building, and it's in the context of any housing market, is that stigma can fade over time. I've seen a lot of that in New York as an appraiser, where there was a murder or some atrocious crime occurring in a building. And over time, that sort of stigma or potential damage to the property fades over time. And I'd like to say that in a tighter market, it fades sooner, meaning that when inventory is tighter, some things fade over time. You have other examples where, the like we had in Newtown, Connecticut, with the mass shooting, that they tore down the building. Um, uh, Rather than, so that it's this isn't a universal solution as, hey, just wait and time will make it better. But in many cases, stigma just fades over time. Um, and hopefully that's clear. I did touch on the Fair Act last week, which is a big thing in New York City, and I wrote about it. And I also yesterday wrote about the rental market. I just wanted to sort of talk in broad strokes about rentals in the U.S. Uh, I looked at, because I specifically tracked New York City rentals, but I also looked at national numbers. And the way to think of the rental market is, and I've touched on this in the past, but the way to think of the rental market in the context of the purchase market is that they're not necessarily, moving in opposite direction. When rents are weak, sales are strong, but it's kind of like that. There's a Mark Twain quote I always refer to, that uh, uh, something like, history doesn't repeat itself, but sometimes it rhymes. Sort of the idea that um, that you can typically expect rents to increase when sales decrease. It may not be an immediate reaction. There may be a delay. And that's kind of what we're seeing in New York. We've been seeing since February. In fact, in the last 4 months, 3 of those months were all-time record highs for rent. That was specifically to Manhattan. Brooklyn and Queens, where we cover, were also, some of the metrics were at or near all-time highs. And the reason for that is higher mortgage rates translate to higher rents. That people that would have organically transitioned from the rental market to become first-time buyers uh, uh, are um, sort of sitting still. They're not, they opted to wait, sign another year for a lease and wait until there's less uncertainty. And that's what I'm sort of working my way up to, is that topic. Um, and so, what we've had is mortgage rates sort of stuck at just below 7%. There seems to be a lot of stability in the sense that mortgage rates don't seem to be doing anything. They were before the tariff tantrums began in April. We were expecting mortgage rates to really drift a lot lower. Um, Most analysts and economists do think that mortgage rates probably aren't going to go anywhere, and the Fed probably isn't going to cut rates in 2025. And as I've mentioned, I've in recent public speaking, I just spoke at the Long Island MLS and a couple of other events, that I think the way to think of the situation that we're stuck in, and maybe this is just a mental exercise for people that are in the agency of real estate, that are enabling people to buy and sell. Um, we have to remember some things about mortgage rates. One is that tariffs, as I said, are inflationary. Um, that high taxes, especially the big beautiful tax bill, if it goes as presented, is inflationary. Um, and then the situation that seems to be evolving in the Middle East, with between Israel and Iran, and the U.S. is probably, through Israel, seems like it's going in the direction of being involved in the war. Wars are inflationary. And so I each one of those items aren't can't stand on its own. There's always, more details. But when we think about an interest rate environment that we were all in real estate thinking that rates are going to drift lower, just those three factors alone reduce the probability of mortgage rates falling. And by mortgage rates falling, um, if we were to have mortgage rates really fall, like to the low sixes, or even the high fives. If it fell to the high fives, I think we'd have one of the biggest housing booms of the modern era. Because what's a little odd about this housing slowdown is that unemployment is low, even though it's tough for college grads, tougher now for them to get a job, in their discipline. Um, and normally, when we see interest rates stuck at a higher level, um, we're expecting them to move one way or the other. But with the current administration, uh, all this policy seems to be sort of baked in place, or lack of policy or lack of strategy. And as a result, there's tremendous uncertainty. And I guess the takeaway from that, and this is probably, I'm overthinking this, but when you think about all the uncertainty in the economy, um, one of the things that I've observed in almost every housing market that I'm tracking, well, I should say every housing market that I'm tracking, in the New York metro area, Florida, Southern California, and then other markets that I sort of, pay attention to. In the last 30 days, um, there has been a noticeable pause or slowdown in activity. And I think it's actually the tangible evidence of, consumers just taking longer to make decisions. Um, but the bigger point here is this idea that and this is, again, this is sort of mental gymnastics, uh, but the uncertainty that's in the economy and in economic policy seems like it's certain. In other words, the uncertainty is a certainty. And as opposed to this sort of back and forth random, there's already been over 50 changes made to the tariff policy, with I'm sure many more to come. And so businesses can't plan or project and that translates into the economy. And job loss, potential job loss, weakening conditions, even though the economy is certain elements of it are pretty strong, like unemployment, being in the low fours, which is very low. You get the sense that, over time, that's probably going to deteriorate. Whatever happens, the idea is that it's a certainty, that the uncertainty is certain. So, for example, if a buyer is sort of thinking about making an offer on a property, and um they're waiting, hopefully rates will come down, in a few months. Uh, I the odds of that happening based on what we know at the moment, and things could change overnight, um, that's not going to happen, or it's unlikely that it's going to happen. So there's almost a certainty that we're not going to see rates fall or be cut by the Fed in the near term. And there's a certainty to that. In the longer term, this does damage the economy, all the uncertainty, and we'll probably, over the next couple of years, see mortgage rates that are a little bit lower than what they are now. I'm not expecting a big correction. And basically, who knows? Me uh, sort of predicting mortgage rates is, one step above being completely silly, because who knows? But just based on what we know, that would be my guess, is that rates will probably be a little bit lower. But there's a certainty to the fact that rates really aren't going to move all that much um, in the near future. And to consumers, um, that I don't want to say it's reassuring, it's not, but it's one less thing that may change, and maybe that helps people make a decision whether they just wait longer or they move faster. I don't know. But I just thought that was interesting that I think everybody's trying to find certainty. And the one thing I've talked about with the topic of certainty in the past, my friend Barry Ritholtz, who has a great blog called The Big Picture and a great podcast called Masters in Business. Um, I was telling him about, uncertainty is more overused than location in real estate these days. And he made the comment to me, and I've mentioned this before, but I just want to reiterate it because it's so important, is that there always is some level of uncertainty. It's just sometimes it's very low and sometimes it's very high. But what we're missing from all this economic chaos is a lack of clarity. We just don't know anything. There doesn't seem to be any sort of design behind, um, other than a misunderstanding of what a tariff actually is, and what the impact to, 3 or 4 trillion added to the deficit will do to mortgage rates. Um, it everything seems to be cast in a way that is going to keep things where it is right now, which consumers will have to get used to. Anyway, I'm rambling a bit. I hope that was helpful. I just want to leave you with the idea that there is a certainty to the constant uncertainty, and maybe that'll help people be able to make decisions about buying or renting or selling or leasing, that the lack of volatility, if it remains, is probably good overall for the housing market. Anyway, with that thought, just one final thought, and I hope you take this to heart, is just remember that pie is always better than cake.